We're going to talk about the biggest story in America now with the person in Connecticut who's in the best position to help us figure it out, George Perez. George Perez is the commissioner of banking for the state of Connecticut. And of course, we know him in New Haven because he grew up here in the Hill and he was the president of our board of alders and was sort of our big star going to Hartford. George Perez, thank you so much for joining us this morning at WNHH-FM.
It's my pleasure, Paul, and thank you for the invitation and opportunity to talk to your listeners.
And, I'm looking forward. We said you're going to come on one day for a longer interview about all the great work you're doing at the Banking Commission. You are the longest serving state commissioner. Am I right?
I think I need one more year.
Oh, yeah? In terms of people who are currently commissioners in the Lamont administration?
Oh, no. The Lamont administration, I think I'm tied with the DSS commissioner. With both.
So what were you referring to? Are you going to be the longest serving banking commissioner ever?
Yes, correct.
Oh, not bad. Not bad, George. When was it 2018 or 2017 when you became the commissioner?
About 2015.
Oh, you see how fast years go. Oh my goodness. Yeah. You look younger than you did, but must be doing good things for you. So, George, the biggest story now is that twice in the last 3 days, not in Connecticut, but twice in the last 3 days, a bank has failed. We had our second biggest bank failure in the history of the United States with Silicon Valley Bank. This is stuff you know, of course, just filling in the listeners, on Friday. And then a second bank, Signature Bank in New York, failed yesterday. What's the reaction here in Connecticut? What does this mean for us?
Well, the first thing I would like to say to people is don't panic. The banks in Connecticut are strong. And the situation that happened in California and New York are much different than what you find in Connecticut. In particular, in California, which is the biggest one, which is the one I'm going to focus on the most. The customer base was primarily high-tech, venture capitalists, fintechs, really big companies. And about 80% of the depositors had more than $250,000 in the bank, which, as people may remember from school or reading in the paper, FDIC only insured deposits up to $100,000, and recently, like 5-6 years ago, that they changed that to $250,000. The good news is that the Biden administration, FDIC, Federal Reserve, which are independent, but they're considered to be part of the administration, have announced yesterday after around 6:15 that they're going to make all depositors whole. What that means is it doesn't matter if you had a dollar, if you had, like in some cases, some companies had $3 billion in that bank, the deposits are going to be made whole. And starting today, when the bank opens, they should be able to have access to it, and they should be able to have their online banking and all that. Now, if they walk into the bank and they want to withdraw $3 billion, that's going to be a little hard because no branch keeps that kind of cash at hand. But it should be business as usual because the FDIC and the Federal Reserve, but in particular it's the FDIC because it's the FDIC insurance, have decided that they're going to make depositors whole.
What does that mean for, now you were talking about Federal Deposit Insurance Corporation, FDIC,
yes,
guaranteeing when you put on $250,000 in a bank, that much is covered if a bank ever fails. And, we do that. We move our accounts around, for instance, at the Independent to make sure that there's not more than that in any one account. Is this going to change the game now, George? Because they're saying that for the bank in New York as well. They're going to cover people's deposits above that $250,000. Is that $250,000 not going to be a real number anymore?
I cannot speak for the FDIC, right? What I can say is based on what I know, they cannot afford to do it for everybody, right? Because people haven't paid for it. I think, and I was in several meetings over the weekend where this stuff was discussed, not necessarily with the FDIC, but with other banking commissioners and the conference of state bank supervisors. The main reason they're doing this is, and the big difference from now to 2A is they're not going to make shareholders and investors whole. Those people are going to lose their money. So that's a big difference. Second, they expect that they're going to sell the bank in an auction, and they're going to generate enough money to be able to cover for the cost, right? So it's going to come out from the insurance fund because the bank is so big and has assets. They feel they're going to break even, if not actually make a little bit of money. There's no guarantee of that, right? If that doesn't happen, they already announced that if the net proceeds of auctioning the bank or breaking it up into little pieces and selling specific assets don't generate enough net proceeds, then they're going to issue a special assessment to the rest of the industry to make up for the difference.
Gotcha.
So this is a quote unquote one-time exception for those two, namely because not so much because investors are losing everything, as they should, because they took a risk, right? And they made decisions, and they made their own decisions, right? But because of the impact it was going to have on the depositors, especially like in the case of Silicon Valley Bank, there were so many large depositors that they would put them out of business if those deposits were to be lost.
Now, your first point was don't panic because you don't want people to be doing run the bank. Everyone's obviously scared about that today. Joe Biden, the president, is going to make a statement because he wants to calm people. So it's true the Silicon Valley Bank was so different because it was mostly startups and tech and fintech.
Yes.
And most of them had more deposits over 250. But if I'm not mistaken, you know so much more about this than I do, George. It was a combination of factors that led to that bank's collapse. Right. Including interest rates went up so fast that in the past, interest rates go up slowly. So depositors don't all take their money out of banks to get more interest somewhere else, right? And
well, that bank was actually paying high interest rate.
Oh, they were? Okay.
Banks.
So that wasn't a factor there.
No, interest rates was a factor, but for a different reason. This is a bank that grew real fast in the last 6 to 8 years because of the fintechs and the high-tech companies, right? And what they did is they took the money and invested it in U.S. bonds primarily. Other investments, but a lot of it U.S. bond. But they did that 2-3 years ago when the rates were lower. And the average yield in the portfolio was 1.79, which was a good yield back then when the prime rate was 0, right? But today the prime rate is 7.75. On Friday, the 3-month T-bill was 4.89. The 1-year T-bill has been going back and forth between 4.9 to 5.18. So in today's market, that yield 1.79 is no longer good. If they would have held those bonds into its maturity, they would have collected back all their money. They would have not lost any money. But what happened was, because they were having cash flow issues, and some real famous big time brokerage firms were starting to recommend that people withdraw the money. On Thursday alone, $42 billion withdrawals were done in the bank. Wow. They ran out of cash. And when they try to sell their bonds, so what they did is to come out with cash, they try to sell part of their portfolio. Because they were selling it early and the rates have gone up and their yield was so low, they sold it at a $1.8 billion loss, which only made the cash flow problems worse.
So are there any banks in Connecticut that have that issue of too much invested in treasury bonds?
The good news is banks are so small that they will never have that kind of exposure, right? I'll be able to answer that question more concrete later today. We are doing an analysis of that. We're not aware of it.
So your preliminary analysis is that we don't have any banks in trouble?
No, not in Connecticut, not Connecticut charter, right? And primarily because our market is different, right? We don't have a lot of high techs, a lot of fintechs, right? We're not New York, we're not California.
And crypto was the problem with Southern, correct?
Yes, crypto was big in New York, right? It's also big in California. In fact, one of the biggest company that would have been in big trouble was the 5th largest crypto company in the nation that had almost 26% of their reserve at Savings Bank of Silicon Valley Bank. Yeah. So yes, that's one of the reasons why I think that the Feds came in, FDIC in particular, to make deposits whole.
Are you getting
Connecticut? We don't have any those kind of deposit mix. Our deposit mix, like for instance, they had a very few true retail customers, meaning people like you and I as customers, right? Or like the bodega down the corner, or the sneakers shop down the corner, right? And their customer base was really big. Raku, I have a couple of names here. Zip Recruiter, all big, humongous companies that were all fintech companies at one time, because they did a lot of lending to those type of entities, which a lot of banks don't specialize in that.
And we don't have that in Fairfield County with the hedge fund industry?
No, the banks that are state charter, don't have.
How about regional banks that are chartered somewhere else but do business here? For instance, I go to Key Bank or.
I don't regulate them. That data can be accessible through the call reports, but they're much bigger, right? And they also have a customer base that's much more diverse, right? They don't have 80% of one particular industry as customers. That's the key there. It's concentration. The thing that we're learning from this, which is similar to what happened in 2A, that's the only thing that's in common, is concentration risk has not gone away. And as regulators, we need to do a better job in cracking down when you have an entity that has that kind of concentration. In fact, to be fair to my colleagues in California, they try to do that. And that bank and other banks went to Congress and tried to say that we're being too mean, too tough, and that we should be more lenient.
Senator Tom Scott took up that call for them just 2 days ago. Did you see that? His timing wasn't very good. George Perez is state banking commissioner. So it's a big day for you, George, isn't it? I would imagine that your office is fielding nonstop inquiries from the public. You said you're putting together an assessment of our banks just to reassure people. I hear you very loud and clear, telling people don't panic. We're not going to have bank failures here. You don't want people running on deposits. What's your day look like? What are some of the steps you guys are going to take?
Well, besides a couple interviews like yours, you're the first one.
Thank you.
At 1 o'clock, I'm going to meet with all the CEOs in Connecticut, not only state charter, but the big national banks like the Bank of Americas and so forth. Now, in that one, I don't expect the CEO of Bank of America to be in this meeting, but the regional president. Where in the state charter ones, all the presidents and their chief financial officers will be in the meeting jointly with the Connecticut Bankers Association. And part of that is to go over the announcement, to make sure and to hear anything that we hear out there, and to make sure people are not panicking, right? And encourage people to communicate with the customers, right? One of the biggest issues that happened in this instance was the communication between the bank and the customer was really, really bad, and with the public. In fact, not only did the bond sale was a fiasco for them, but then they tried to issue stocks. And because of the run of the bank and the lack of communication, that collapsed too. So that's when the Feds had to come in and bail them out because they didn't have enough cash. So the key here is communication, reassuring the public. Connecticut banks are much different than those two banks that we're talking about. It's just our market is different. We don't have that kind of high.
So you're meeting with CEOs. I assume that's by Zoom, George?
Yes, it's all going to be done by Zoom.
And you're meeting with them just to get information from them and to spread the word about your concern about keeping communication lines open with customers. I hear you saying that your staff is just renewing its assessments of the state of the banks. Anything else going on today? Are you fielding a lot of calls from just everyday consumers?
Not, to be honest with you, not one single call today.
Really?
Consumer. Not one. So that's good. I mean, that's the way we want it.
That is good.
And that's the way it should be. No Connecticut bank has been taken over, and there no reason for it that I know of for any Connecticut bank to be taken over by the Feds or us or anybody else in the near future.
And you remember what it's like to work at the banks and be in those meetings when you're running a bank. So I can imagine that you'll know when you go on this call today what people need to hear.
Yes, in fact, not only through merchants, but I actually worked at a bank that was taken over by the FDIC.
Oh, really?
First Constitution.
Oh, yeah.
Way back in the day, the Western Bank ended up buying it. And again,
I want to say that was the mid-90s, early to mid-90s.
Yes, that was in the mid-90s.
And I remember that they had done a lot of these co-loans where they took equity stakes in companies. Wasn't that one of the big mistakes?
Yeah. What happens is when a bank deviates from the cookie cut, what I call the cookie cutter approach, right? Mortgages, car loans, home equities, and they start going and specialize in particular fields or really high concentrations. That's when you get in trouble. That's when you tend to have issues.
What do you remember from that incident when you were there when you were present at the takeover?
Well, at that time I was an assistant vice president, which is the lowest level of management. I have very little to do with what caused the issue. But I mean, as an employee, you feel depressed, right? You're going to lose your job, or you could lose your job, right? In my case, the surviving entity who bought it offered me a job, which I didn't take because I didn't want to travel outside of New Haven. So I went with the competition. The other thing is that there's a lot of secondary market that gets impacted by this too, right? I mean, there are people like United Way, right? Those donations are no longer going to come from those banks, right? They're laundry mats, right? And they're grocery stores, they're restaurants that those employees used to go and eat lunch and so forth, right?
Right.
So there's a lot of impact that happens beyond the depositors and and investors. So, I mean, it was not fun. I mean, as much.
Well, I'm glad we got you at the helm to make sure you were not people are
Thank
going to
you.
have a repeat of that scenario in Connecticut. Wish you luck today dealing with the CEOs, helping to reassure the public. And thanks so much for making time, George Perez, State Banking Commissioner, tied for longest serving current state employee on the route to becoming longest serving.
I don't know about state employee. You say commissioner.
State commissioner, excuse me, not state
That's
employee at all.
administration.
State commissioner. George, thanks so much for making time. We miss you in New Haven, and we're glad things are going well up in Hartford.
All right. Thank you, Paul.
And have it. Good luck today in dealing with this.